On Wednesday at 12:11 in the afternoon, the world's most important silver market went dark. Not slow, not glitchy, dark. Every standing buy order you had placed that morning was gone. Every good till date order wiped from the system. If you had been sitting at your screen watching silver climb toward $91 for the first time in weeks, the screen just stopped. And CME Group's official explanation for why the exchange that prices silver for the entire Western world shut down in the middle of a trading day? 2 words: technical issues. That is all they said. No press release with specifics. No technical postmortem. No independent audit announced. 2 words on a status page that read, investigating. And then silence. I'm going to show you why those 2 words are the most suspicious thing that has happened in this market in years. Not because I am going to tell you what happened. Because I'm going to show you the data that was left behind. And data does not lie the way press releases do. Today is February 27th. Silver is at $90.51 right now. And today is March 1st notice day, the single most consequential deadline in this entire contract cycle. The day when every long holder of a March futures contract can formally demand physical delivery of real silver bars. Whatever happened on Wednesday, it happened 48 hours before today. And when you understand the timing of what occurred, the numbers that were moving when the lights went out, and the history of the last time this exact same thing happened, the 2-word explanation becomes very hard to accept. Let me start at the moment the evidence trail begins. Silver had been climbing all week. By Wednesday morning, it had pushed through $90 and was advancing toward $91. That level matters. Not because it is a round number, because $90 to $91 is the technical zone that multiple institutional analysts had publicly identified as the ceiling above which naked short positions in silver futures face serious covering pressure. The closer silver gets to $91, the more expensive it becomes for the short side of this trade to hold their positions. Every dollar higher is a dollar of losses per ounce on every uncovered short contract. At 12:11 Central Time, CME's Global Command Center issued a warning. A technical issue was impacting metals and natural gas futures and options. 4 minutes later at 12:15, the exchange confirmed a full halt. Natural gas came back online at 12:50, about 50 minutes after the halt began. Metals stayed dark for 90 minutes. Gold, silver, copper, all of them. Not reopening until 1:45 Central Time. When silver came back, it was trading at $88.20, down $3 from where it had been when the lights went out. The advance toward $91 was over, the pressure on the short side was gone, and every single buy order placed before the halt had been wiped from the book. That is what the timeline shows. Now let me show you what makes the timeline impossible to dismiss as coincidence. This was not the first time. On November 27th and 28th of 2025, less than 3 months ago, CME suffered a 10-hour shutdown. The initial explanation was a cooling system failure at their data center in Aurora, Illinois. That explanation was later quietly revised. CyrusOne, the data center operator, admitted in a December statement to Bloomberg that the outage was caused by human error. Staff and contractors failed to follow standard procedures for draining cooling towers ahead of freezing temperatures. The cascade began at 3:40 in the morning, a full day before trading went dark. There was ample warning. The backup data center in New York was available and ready. CME chose not to activate it because they believed the outage would be brief. It lasted over 10 hours. And that 10-hour outage in November fell precisely on first notice day for the December 2025 silver contract, the single most consequential delivery deadline of that entire contract cycle. Now look at Wednesday's halt. It fell precisely 48 hours before first notice day for the March 2026 silver contract, the single most consequential delivery deadline of this entire contract cycle. 2 outages, 3 months apart, both landing within 48 hours of first notice day for consecutive contract months, both occurring while silver was advancing toward resistance levels that threatened the short side of the trade, both receiving vague official explanations with no independent audit, both resulting in price declines that eliminated the pressure that had been building on the short side. You can call the first one a coincidence. The second one is a pattern. Now let me show you what the vault looks like, because this is the context that makes the timing of both halts meaningful rather than random. COMEX registered silver, the only category of inventory that can legally be delivered against a futures contract, stood at 87.17 million ounces as of the last confirmed report. In October 2025, it stood at 167.7 million ounces. In 2020, it stood at 346 million ounces. That is a 75% collapse in the physical foundation of the world's primary silver futures market in 5 years. And the drain has not stopped. It has accelerated. Full year 2025. COMEX silver deliveries totaled 474 million ounces. In 2024, the number was 203 million ounces, a doubling in a single calendar year. December 2025 saw 46.6 million ounces physically delivered. That is 50% of the entire registered inventory consumed in a single contract month. January 2026 recorded 49.4 million ounces delivered, a number so far above historical January averages it effectively has no precedent. And the February 2026 delivery rate is running at 98% of standing contracts. Let me tell you what 98% means. Under normal market conditions, only a small fraction of futures contracts ever result in physical delivery. Most participants roll their positions forward, take cash settlement, or close their trades before the delivery window. A delivery rate near the single digits is normal. 5 to 10% is elevated. 20% signals stress. 98% means institutional participants have made a deliberate, coordinated decision to remove physical metal from the exchange system, regardless of what cash alternatives are being offered. They do not want the paper settlement. They want the bars. And they are demanding them at a rate that has no historical parallel in this market. That is the vault the halt occurred against. 87 million registered ounces, draining at rates that have no precedent, being demanded by holders at a 98% delivery rate, 48 hours before the next delivery deadline. And silver was 20 cents away from $91 when the lights went out. Now add the physical market signals that cannot be manufactured by an exchange halt or reversed by a press release. Because these are the numbers that tell you what the market actually thinks is happening beneath the surface pricing mechanism. London silver lease rates peaked at 34.9% on October 9th of 2025. To understand why that number is alarming, here is the baseline. Lease rates in normal market conditions run below 1%. During the October 2025 peak, borrowing physical silver for institutional delivery cost nearly 35% annualized. That is not a temporary arbitrage. That is an institution paying almost 35 cents per dollar per year just to borrow physical silver because they need it for delivery obligations they cannot fulfill any other way. Those rates have come down from the October peak. But the fact that they reached 34.9% tells you something permanent about this market. The physical sourcing problem is not new. It has been building for months. The vault drain is the result of that sourcing problem playing out in real time over an extended period. Wednesday's halt is one moment in a much longer story. Meanwhile, physical silver in the real world is pricing completely differently than the paper market claims it is worth. When silver was crashing in late January and the COMEX paper price was being driven toward $72, physical American silver eagles at retail dealers were commanding premiums of 30 to 40% above spot. The paper price said one thing. The physical market said something completely different. And the physical market was the one where you could actually take possession of real metal. That gap has never fully closed. Right now, physical silver through major retail dealers carries premiums above spot that are multiple times the historical norm. The COMEX price is the price you can see on a screen. It is not the price you pay when you need real silver delivered to you today. Now here's the data point that dropped yesterday and changes how you read everything else in this video. Jane Street, the largest quantitative trading firm on earth, disclosed in a 13F filing that it added 20.6 million shares of SLV, the iShares Silver Trust, in the fourth quarter of 2025 alone. That brought its total SLV position to 20.7 million shares. Jane Street is now the single largest holder of SLV in the world, larger than BlackRock at 20.5 million shares, larger than Morgan Stanley at 18.1 million, larger than Bank of America at 10.5 million. Jane Street surpassed every other institutional holder of the world's biggest silver ETF in a single quarter. In the third quarter of 2025, Jane Street held 41,100 shares of SLV. By the end of December, that number was 20,772,537. That is a position that grew by more than 50,000% in 90 days. That 13F filing was disclosed on February 12th, 13 days before the halt. Now here's the detail that changes everything about how you read that position. The same 13F filing reveals that Jane Street simultaneously holds 39.5 million SLV call options and 43.3 million SLV put options. More contracts and options than in shares, and roughly equal calls and puts. That is not a bullish position. That is not a bearish position. That is a volatility position. When you hold that many calls and that many puts simultaneously, you are not betting on the direction silver moves. You profit when silver moves violently in either direction. The bigger the swing, the more you make. And Jane Street built this position while silver went from $71 to $121.79, crashed to $63.90, recovered to $91, halted, slammed back down, and is now sitting at $90.51 on first notice day. If you were positioned for volatility, this market has been delivering exactly what that position requires, every single week. Jane Street is not a passive investor sitting in a long-only fund waiting for silver to go up. It is one of the most aggressive quantitative trading operations on earth, built for speed, arbitrage, and flow extraction. And it is an authorized participant in SLV, which means it has direct institutional access to exchange physical silver for SLV shares, and vice versa at scale. Let me tell you why that authorized participant status matters in a way that most coverage is not explaining. When you buy SLV, you are not buying silver. You are buying a share in a trust that claims to hold silver. The authorized participant is the entity that creates and redeems those shares by moving actual physical silver in and out of the trust. Jane Street, as an authorized participant, sits at the exact intersection where the paper ETF market and the physical silver market connect. It can move metal in and out of the trust in ways that are not visible in real time to anyone outside the transaction. A $165 billion position built at 50,000% speed, disclosed 13 days before the halt, held alongside 39.5 million calls and 43.3 million puts in a volatility strategy by an authorized participant with direct physical access to the largest silver ETF in the world. That is not a passive investment. That is a structural foothold at every critical node of the silver market simultaneously. Now look at what happened in Shanghai during the same period. Because the contrast between how Eastern and Western exchanges handled the same market stress is one of the most revealing pieces of evidence in this entire story. When the Shanghai Futures Exchange identified participants exceeding position limits during the silver squeeze, it suspended 25 trading accounts in February alone. 25. 1 month. Public enforcement action. The exchange saw stress building and acted visibly, with consequences, in real time. COMEX, operating under materially greater delivery pressure, took no comparable public enforcement action during the same window. One exchange suspended accounts, the other halted trading, wiped standing orders, and issued 2 words. And while COMEX was dark on Wednesday, Shanghai was open. Shanghai silver was trading at approximately $100 per ounce during the period when COMEX went dark. The Western paper price and the Eastern physical price were separated by roughly $10 to $12 per ounce during the halt. The gap between what Chicago claims silver is worth and what Shanghai is paying for physical silver has never fully closed since January. Every algorithmic sell, every margin hike, every halt has compressed the Western price. The physical reality in Shanghai has not followed it down at the same rate. That divergence is not noise. It is the market telling you in the clearest language available that the two prices represent two different things. The paper price is the price of a promise to deliver silver if asked. The physical price is the price of the metal itself when you actually need it today. Those two prices are supposed to be the same number. They are not the same number anymore, and every intervention that lowers the paper price without touching the physical reality widens the gap rather than closing it. Now I want to take you back to the two halts and what the combined evidence of both is telling you. November 2025, 10-hour halt. First notice day for December silver. Official explanation revised from equipment failure to human error. Backup data center available but not activated. Price behavior before and after the halt consistent with delivery pressure being managed off exchange. February 2026, 90-minute halt. 48 hours before first notice day for March silver. Silver 20 cents from $91 when the lights went out. Silver at $88.20 when they came back on. Every standing buy order wiped. Official explanation, 2 words. No specifics, no audit. 2 halts. Consecutive contract months. Both in the 48-hour window before the most consequential delivery deadline of each cycle. Both while silver was advancing toward levels that threatened the short side of the trade. Both resulting in lower prices when trading resumed. Both explained with the minimum possible public disclosure. The probability that these two events are unrelated infrastructure failures with coincidental timing does not survive honest calculation. What the data requires you to conclude, not speculate, but conclude from the documented evidence, is that the silver market has a mechanism being applied at exactly the moments when physical delivery pressure threatens to break through the paper price ceiling. The mechanism does not have to be coordinated conspiracy. It does not have to be a phone call between executives. It simply has to be a system that responds to stress by protecting its most critical structural interest, maintaining the paper price as the price of silver rather than allowing the physical market to set it. When the paper and physical prices diverge to the extent they have in this market, the paper pricing mechanism has an existential interest in not letting the physical price win the argument. And the most direct way to prevent the physical price from winning the argument is to stop the market. At the moment, the physical pressure is about to become visible in the paper price. The halt stopped silver 20 cents from the level that breaks the short side. When it came back, silver was $3 lower. The argument was deferred, not resolved. Here is what makes today different from Wednesday. Today is first notice day. The halt bought 2 days. Those 2 days are now over. The vault still holds 87 million registered ounces. The delivery demand is still running at 98% of standing contracts. May open interest is still sitting at 350 million ounces. The lease rates that reached 34.9% in October have not reversed the structural scarcity that drove them there. Jane Street still holds 20.7 million SLV shares alongside 82.8 million options contracts. Shanghai is still pricing physical silver at a double-digit premium to COMEX. Two words did not change any of those numbers. The halt did not add 1 ounce to the vault. The wiped orders did not resolve the delivery math. All of the structural pressure that existed at 12:11 Central Time on Wednesday still exists at this exact moment on first notice day with silver at 90.50 Ors. The system bought 2 days. It did not buy a solution. Here's the honest, bearish counterargument, because you deserve the full picture. CME's November outage was caused by a documented physical infrastructure failure, human error in a data center, not a deliberate intervention in the market. The explanation is on record and independently corroborated by CyrusOne's own statement to Bloomberg. Incompetent infrastructure management and deliberate market intervention are two very different things, and the documented explanation for November fits the former. Wednesday's halt affected natural gas as well as metals. Natural gas has no delivery squeeze, no vault crisis, no short side pressure problem. If the halt was designed to protect silver shorts, why did it take natural gas with it? A genuine infrastructure failure affecting multiple product lines is more consistent with the two-word explanation than a targeted intervention. And the fact that the halt happened during regular trading hours, in plain sight, reported immediately by Bloomberg and Reuters, is not consistent with sophisticated market management. A truly deliberate intervention would more likely occur in the overnight session when fewer eyes are watching. These are genuine points. The incompetence explanation is real and documented for November. The simultaneous natural gas halt is a genuine complication for the deliberate intervention interpretation. But here is what those counterarguments cannot explain. The timing pattern holds regardless of cause. Whether the November halt was incompetence or intervention, it fell on first notice day for December silver. Whether Wednesday's halt was incompetence or intervention, it fell 48 hours before first notice day for March silver. If CME's infrastructure is so fragile that it fails at critical delivery moments in consecutive contract months, that is its own serious indictment of the exchange's fitness to price the world's silver market. Incompetence at exactly the worst moments is not a defense. It is a different kind of failure. The wiped orders remain the most difficult fact for the accident explanation to absorb. Good till-date orders were canceled during the halt. That is an active decision about order book management, not a passive consequence of a system going dark. Someone decided those orders would not survive the restart. That decision benefited the short side of the silver trade at a moment when the short side was under maximum pressure. And when trading resumed, silver was $3 lower. Gold recovered. Silver did not recover the same way. The metal with the delivery problem behaved differently from the metal without one, in the same macro environment, on the same exchange. Right now, on first notice day, the only question that matters is what the vault report shows tonight and what the first wave of delivery notices reveals about the appetite for physical silver at current prices. Watch tonight's CME depository statistics at 6 p.m. Eastern. That report will be the first post-halt, post-first notice day data point on registered inventory. Watch whether the drain continued, whether any eligible to registered transfers occurred, and whether the 87 million ounce floor held or broke lower. Watch the delivery notices filed today and over the next week of March settlement. If the 98% delivery rate holds into first notice day, the vault faces genuine strain against the paper open interest remaining. If holders accept cash settlements at scale, the delivery pressure is deferred again to May. Watch May open interest. It currently stands at 350 million ounces against 87 million registered ounces, 4-1. If the March rolls continue into May without the vault recovering, May faces structurally worse math than March did when the squeeze began. Watch the Shanghai premium. If the gap between COMEX paper prices and Shanghai physical prices widens after today's first notice day, rather than narrowing, the physical market is sending a clear signal that the 2-day window bought by the halt did not resolve the underlying supply scarcity. And watch whether CME issues any further explanation for Wednesday's halt. An exchange that prices the global silver market for hundreds of millions of market participants owed more than 2 words to the people whose orders were wiped from its system during the most sensitive 90-minute window of this entire contract cycle. The fact that nothing more has been released is itself data. Here's what I keep coming back to after going through every documented piece of evidence from the last 72 hours. The silver market has produced more physical stress signals in the last 3 months than it has in the previous 3 decades. Lease rates at 34.9%, delivery rates at 98%, registered inventory down 75% from 2020. 2 halts in 3 months, both within 48 hours of first notice day for consecutive contract months. The world's largest quantitative trading firm becoming the world's largest SLV holder at 50,000% acceleration in 90 days. Disclosed 13 days before the halt. Shanghai pricing silver at a persistent double-digit premium to COMEX through every intervention attempt. Every one of those data points is verified and public. Every one of them is pointing in the same direction simultaneously. The paper price is $90.51. The physical market is saying something different. And the exchange that is supposed to reconcile those two prices has now gone dark twice in 3 months, at exactly the moments when the gap was about to become undeniable. Wednesday was not the crisis. Wednesday was a window into the structure underneath the crisis that has been building for months. Today is first notice day, the window is open again, and this time the halt is over. Pull any of this data yourself. The CME Group Vault report publishes daily. The delivery notice data is available through the exchange. The Jane Street 13F filing is public through SEC Edgar. The Bloomberg data on lease rates is documented. The Reuters and Bloomberg reports on both halts are linked in the description. Verify every number. Then look at 87 million registered ounces, facing first notice day for March, with 350 million ounces already loaded in May behind it. And ask yourself whether 2 words is an adequate explanation for what happened on Wednesday. Or whether the most important silver market in the Western world just told you more than it intended to,